Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, February 2nd, 2022. In this video, I'm going to take a look. It won't be a very long one, but I want to go over a few things in the market, where we're at right now, where I think we're going, key levels to watch, and I'm going to do a comparison. I'm going to analyze. We're going to really do a deep dive and analyze this bounce here and talk about just kind of pick it apart and try to figure out if it is it's been very impulsive lift in the markets last few days, last few sessions. And is it the beginning of the road to new highs and beyond, as has been the trend for years now, every time we had a correction, this being the deepest? Or is it just a counter trend bounce with another leg down to come? I will say that's still my preferred scenario. I'm going to throw this out. I always do. The only guarantee I'll ever give you in trading, or at least from this site or investing, is the only guarantee I'll ever give you is that I will be wrong at times. You will be wrong. And so my convictions have remained high that we're going to probably have another leg down and considerable more downside in the market in the coming weeks to months. I'm going to do my best to try to thread the needle. That's what this is all about. Trying to determine when we're going to bounce, when in other words, the inflection points. So I'm going to dig into the charts here and show you a few things. I'm also going to make a comparison to the last couple big drops that we've had in the market. The closest comparisons I can make. I'm not cherry picking times. I'll get to that in just one second. We'll look at the counter trend bounces when we had the COVID first grabbed hold of the markets back in February of 2020, and then the big drop in the fourth quarter of 2018. Those are the only corrections that compare to this one that are close enough. So let's just talk levels here. SPY. Remember, SPY hit that 424.45 support / price target right when QQQ hit my first target on both the daily and weekly charts. So again, at the time it was mentioned, tradable bounce was likely. Active traders can game a bounce, and there's certainly been a tradable bounce to be made. So again, the bounce wasn't random, didn't come out of the blue. But whether this is again time to exit those longs if you happen to ride it all the way up here, or if you are a long side trader looking for new highs, what you need to look for going forward. In other words, you don't want to, if you are long and you're holding out for new highs, you don't want to give up all those profits if you bought it at anywhere down here recently. Okay, before we pick apart the bounce, let me just say I want to point out this is a pretty key level. Remember, on the SPY, now I don't trade. I'm not trading the SPY. The QQQ is where my focus lies. But on the SPY, I really wanted to see the bounce contained at the bottom of this multi-month, 2-month long trading range, which remember was a back test of the breakout all-time highs right here. And we're right about there right now. So that's about as far as I wanted to see SPY bounce. However, QQQ has a little room in my opinion, but I want to say that that's a back test right now, and that's why I threw that post out to you guys in pre-market today. I think where we were at the pre-market highs was a very objective shorting up. I made that pretty clear, and I see about maybe another 2% more upside on QQQ to where I think that bounce would be within the realm of normal. Doesn't mean we can't just go ahead and clip my highest bounce targets by 2-3%. If so, yeah, and they stop me out any or all my position, I can always get back in. Sometimes you try to identify max bounce targets, and the bounce may just exceed that, and then what you were expecting does play out. As of now, we're still within the realm. Again, SPY's pushing the upper limit, what I wanted to see, but again, I'm not shorting SPY. I don't care about SPY. This is what I care about because this is the market leaders. If this breaks, SPY will break. QQQ has a much higher weighting of the same top components SPY does, and that's Apple, Microsoft, Amazon, Alphabet, Tesla, Facebook, etc. All right, so that's it. I just wanted to say where we're at there, and then this is what QQQ looks like. Again, daily swing target there. Weekly target was T1, just a sole level around 342. Hit, bounce. Nothing out of the norm. In fact, perfectly normal. And again, I'm going to tear apart this bounce and kind of pick it apart with a fine-tooth comb. But where we're at, here's what I got out to you this morning. When you jump down to a 60-minute chart, Just a beautiful level of resistance right here. You have a, why is this a level of resistance? Well, price-wise, you have a gap. Oh, I didn't get it there. A gap right there and a gap right there. So that line is there for that reason. You have a major reaction low more recently, which is more significant. You know, I give a higher weighting to recent reactions. Then you traded on that level for a while there, you can see, and it finally broke, and when it broke, it was a waterfall sell-off. So that's a big resistance level, in my opinion. Comes in right around 370. And on top of that, it's Fibs. Now I'm gonna, if there's a theme for this video, we're gonna call it Fun with Fibs. Now, Fibs, you know, when you were a kid, your parents said fibs are bad. Fibs, don't tell lies, you'll get in trouble, don't fib. And I'm going to just loosely paraphrase Gordon Gekko from the movie Wall Street. Fibs, for a lack of a better word, are good. And why are they good? Well, we're going to get into that in this video, but there it is. We're right at price resistance in the 50% fib, and I say this often. It never fails to amaze me when I always put my price levels on the chart first, price horizontal price and resistance levels, trend lines, and then when I add the fibs on the major moves, because these fibs right here come off the all-time high right there in QQQ. There's our drop. It was about 17% or so, and we hit today at the high. When I got that post out to you, we're trading right at the 50% fib. So far a rejection. That doesn't mean we're going to stop. And so here's the thing. I can never guarantee anything in trading, whether I'm going to be right or wrong, but I can guarantee you I work hard to get out the key levels that are likely to come into play, produce reactions where sellers and buyers meet. And what I can guarantee you is that's an objective level to short. I can't guarantee it'll pan out, but I certainly like it because, again, it's a combination of price and fib resistance. Remember, there's subsets of traders out there that don't use fibs. They only look at price levels. And there's also a subset that only trade fibs. And that's why I like to use them both. And again, they often align. And then you can see if we happen to pop, as I mentioned earlier, here's the 61.8 fib. That's typically the top end of the range. It's been my experience that most counter trend bounces, if that's what this is off the lows with more downside to come, most counter trend bounces end between the 38.2 and the 61.8% fib. And they usually hit one of those levels. Sometimes they'll go in between. We'll see that in a second, but that's it. So all I can tell you, it's objective to short there. And the upside, if we hit that next fib and pretty good, even very good price resistance as well, you can see a couple major reaction lows right there, a gap right there. We can dance around another gap right there, all recent. So you have nice price resistance, about 378 almost, and then the 61.8% Fibonacci retracement. So we're getting very close, and this is where I start getting aggressively, layering on those shorts where I'll be up to a full position. Now, let me just define that real quick for those of you new to the site. A full position doesn't mean my entire portfolio short the Nasdaq 100. It means whatever. I always trade a balanced portfolio. I have commodities and gold, silver at any given time, not always, but usually some of those things, individual stocks. I may even have long stock positions and short stock positions. I don't want to digress, but that reminds me, I need to tell you guys, the Netflix, I put it on the site as an official trade recently. We hit support. That's pretty much hit the bounce target. I gave you this chart right here. Bought it at the 378.40, big support right there. We're coming very close to, and we might even hit it in the pre-market session if I turned it on. That was the bounce target right there, about 475. And remember, when you're in a downtrend, there's a big sell signal. You don't want to hold out when you're trying to trade long and your target, you see resistance at 474.95. You want to sell a little bit early, and I think we might have hit that in pre-market. I didn't check today to see where it went. I saw this yesterday. I meant to get that out to you guys. I just wanted to say, time to take profits. At least here, I'll tell you right now what we hit today. Edit chart properties. We show there was a high right there. That's pretty darn close. You can see the top of the candle. I turned on to show you how high we got in pre-market. So maybe we push a little higher, but I would very, very much expect a reaction there, and highly recommend if you took that long when it was thrown out a week or so ago, and you made 20% in less than a week. take the money and run. Don't get greedy. That's my thoughts. Or at the very least, if you're very bullish, and you got it anywhere near there, at least ratchet up your stops so you don't give back a good part of that 20% gain in less than a week. All right, so sorry to digress. That wasn't what the intention here is to just focus on the Nasdaq 100 today and the S&P. And okay, back to where we were. So that's it. Beautiful level right there. And if we go up a little more, that would also be an objective short entry. Being that the S&P 500 is at the bottom of that range right now, which is big resistance, it would be ideal to see this rally get capped here. I just say that. So, I might not be all in at that point if we go up there. I might wait until we see a reversal. Of course, you have Facebook reporting tonight, so that can move the markets, and they had a pretty constructive chart, but we'll see. All right, so those are the levels. And then my point is, after that, I would not add any more shorts. In fact, I'd be more concerned about scaling out. I usually like to scale in and scale out when I'm especially when I'm swing trading and trend trading. Day trading, that's take a position, get in, get out. So that is more of my plan there. And look, if sometimes it will exceed my max bounce targets, got a downtrend line at the highs, maybe we go up that far. And if we reverse, it can always layer back into those shorts. But I'd be more concerned at this point, adding up to that point, but not above that, about a little bit above 378 or so. Okay, so onward with the Fibs. All right, so a perfect rejection. Look at this. I mean, right on the button. Nothing huge. Again, maybe it's just a little minor pullback is all we're going to get, but so far that's what stopped this rally. And you can see here when you look at the 1-minute chart, turn on the pre-market trades, that's where we were when we hit it this morning. That's when I got it out to you, and you can see so far a rejection off there, and we dropped from hitting that fib. The sellers came in pretty hard on the initial tag and dropped, the Qs dropped 1% pretty quickly. And a little kickback rally, and we're back down now. All right, now it's not all about the Qs. It's a big part of, what I like to see, but also SPY, again, to the button. It was up just a hair higher in pre-market. A perfect tag, I think it was in the pre-market section, a perfect tag or close enough to that 61.8 fib. So you can see SPY's retraced a little bit more than the Nasdaq 100, which also talks to the weakness in the tech-heavy Nasdaq 100. Because as I said, if the Nasdaq 100 breaks, the market will break. So that's it. Let's not beat a dead horse. Perfect so far, perfect or near perfect, 50% and 61% 8 retracements on SPY and QQQ. I also showed you NQ, but that's a 5-minute chart. I told you the 5-minute charts for active traders. Yesterday I highlighted this rising wedge. There was a breakdown there, and there was a trade to be made on the NQs. That was better than a 1% drop. And then we pushed up last night. This is what Google or Alphabet did to the NQs with their earnings. But then you had this, you set up again, just like you had right here at this point, negative divergence right there. And you had a correction. You again put in a divergent high, see your negative divergence on the 5-minute, and then you had a little trend line there. So again, I didn't get this out. This was all happened since yesterday, but this is how you can track that 5-minute chart and trade it. Even, as an active trader, you had a divergent high there this morning. At the same time, you hit that 50% fib, and there was a 1.62% drop. Very lucrative if you're day trading, even a single contract of NQ or the MNQs, the minis, if you want to do that instead. All right, but what I wanted to show you here, this is the 120-minute. This is a chart I gave you this morning, shows 2-hour candles. There's your all-time high right there in the Nasdaq 100 futures. There's that 17 or whatever percent drop into the lows, and these colored lines here are the Fibonacci retracements. Right here in yellow is the 50% to the button. So again, fun with fibs. You had at the same exact time the Nasdaq 100 hit the 50% fib, which was also price resistance, just like on QQQ. You had at that very same moment the Nasdaq 100. I'm sorry, the S&P 500. This is ES, the E-mini futures for the S&P 500. You have price resistance there as well. There's a major reaction low, reaction high, another reaction low there, reaction high, reaction low, and that is price and the 61.8% Fibonacci retracement to the button. I mean, literally, it doesn't get any better than that. So, what are the odds? Is that mere coincidence that you had the Nasdaq 100, QQQ, NQ hitting the 50% right as the S&P hit the 61.8? Not to mention also perfect, near perfect tags of price resistance. No. So the takeaway is this is trading. All you can do is take shots where the odds are high. And again, it doesn't. This may be just a little reaction, but it does tell you, if nothing else, the takeaway here is that traders watch and trade off these levels. And if you were looking to get short, any short, here or there is just random. You want to short at these fibs. You want to short at the 50 percent retracement, especially at the same time. This is yes, if QQQ hit a key level, and it might not have, but when you get both hitting those levels, especially with that SPY back testing or the S&P 500 back testing that recent trading range where we broke down, and that was those were the pretty solid sell signals that we got when those trading ranges gave way. I just want to say this is about as good as it gets in my opinion, guys, and I'm either going to be wrong or we're going to go up here and then you get stopped out. But if you shorted back when we had sell signals on QQQ, you're still profitable. If you get stopped out now, it should be stopped out if those were your initial shorts and you were a trend trader. And I'm talking about where the multiple, all the initial shorting ops were before the drop. The market was right here. This is where we shorted here on that breakdown here, and then every pushback to the 401 level. So again, there's no way you should go negative if you're a trend trader, and that's your average cost is up there. You're still very much profitable even after this big rip. So now let me get to the good stuff. All right, so we're going to go back in time. I'm going to turn off all these lines. I'm going to roll this back. And again, the only two periods comparable to this, again, a QQQ from the high to the low, QQQ fell was 18.24%, right? The only corrections that we have comparable to that in recent years are when COVID hit and it took hold of the markets back in February of 2000. That was a drop total before all said and done 30, but we're not looking at that. This to me is the initial leg down, I believe, in a bigger drop, and I'm viewing this as a counter trend rally. So we're going to examine these counter trend bounces and look at similarities. So before I do that, let me just reiterate 18.24%. The bounce so far has been good for about exactly 10.67% to the highs. So again, I do this because if you're new to trading or investing, you might say, wow, this is nothing but bullish. That's pure bullish price action. Well, it may feel that way, and it may prove to be, if the market goes on to new highs. But let's pick these apart. All right, so we're going to go here. There's the COVID drop. I'm going to zoom in so you can see it well on the video. It's good enough right there. All right, there's the high back in February 19th. And it was a quick one, just a matter of 1.1 months. You can see my pop-up box if you look down to the left, on the left towards the bottom. The drop was 30.55%. All right, so this was our initial leg down, and I'm measuring. The pop-up box will show me in red on the bottom. That was a 16.43% drop. Very close, all right, to what we had so far, even less back then. And the counter trend bounce was the first counter trend bounce that was tradable was an 11.4% rally. So keep that in mind. So in other words, that first counter trend bounce there with a lot more downside to come was even more powerful than what we had. And let me show up and put on the fibs for you and we'll look at that. Grab the high right there. Oops, I need to change boards. 1 second, let me delete that and go to a clean board here. There we go. And now we look at the fibs. Grab that high, come into that low, And you might not be able to make it out. I'll just tell you what it says here. These are the fib numbers over here. 50%, almost to the button. Here's the 50% Fibonacci retracement level. And you can see that's what capped that rally. Ran up, tested it for 2 days, and then boom. That's all she wrote, right? Okay, so I just want to say that this retracement right now, remember that's what we just did in the Nasdaq 100 we hit this morning. You had an opportunity to short at the 50% retracement, and it was no less bullish when the market rallied almost the same amount here in just a matter of 3 days. Okay, and that's about what we did now. So that's all I'm trying to say. Don't confuse what appears to be a very bullish price action, impulsive buying, because when during corrections volatility expands and the daily swings up and down are a lot higher. So this is the norm, and you just have to put things in perspective and compare them to other similar events, corrections in the market. And then from there, if you shorted that 50% fib or anywhere around there, and held for the next leg down, you made another 25%, and we gamed that. And I can you can go back and reference the trades on the site. I'm almost certain we were short right off the top with trendline breaks. We covered right around that level. We gamed most of that counter trend balance long, and then I put it back on as a short. And I remember covering just shortly before the lows there, and covering that and then going long again. So just like now, you can game these counter trend bounces as an active trader, and who knows, maybe this is not going to play out that way. I just want to say the similarities are, I don't want to call them uncanny. This is just the nature of a correction is all I'm trying to say, and so far that's why I'm keeping that view I have, that we're probably right now in a counter trend bounce, just like we were back then when COVID hit. Okay, so that's that. That was really only one, that was more of a, this even looks, ABC, corrective wave. If you're an Elliott waver, it was just an ABC simple corrective wave instead of a 5-wave primary down. It was big. It was considered technically a bear market, but to me it was just a correction in the ongoing bull market because the, Fed stepped in and made sure it didn't get any worse. Okay, we're going to roll back to the previous one. Again, the only other closest analogy is back here in the fourth quarter of 2018. We had a drop in the Nasdaq 100 of about 24%. So again, you can call that a bear market if you want, more of a correction, about 24%. So we're going to zoom in a little tighter on that one. There we go, and now we can pick it apart. Okay, let's start with just quickly the percentages. So you have from that high right there, which was about an equal high to the previous one, so we'll just pick this one. The initial drop was 10.5%, followed by a counter trend bounce of 6.23, but that was only, again, 10.5% drop. This is more comparable to what we've just experienced. This was a 14.63, we'll call that 15% drop, or you can use this one, which is even closer, about a 16% drop. So let's measure that real quick. So from there, after dropping a little over 16%, we had a sharp counter trend bounce that was 10.3%. On this one, the counter trend bounce was about 9.66 or 10%. So again, right about where we are today. So if I am correct as a counter trend bounce, it is perfectly well within the averages or the window of comparable drops, how much you bounced after falling, about as much as we just did. Now let's have some fun with fibs here. Take that top level, come down. We'll start with this first bounce. Put it there from the high to the low, right on the button, 50% retracement. There's the 50% Fibonacci line right here, and that's what capped that bounce. Take that line, pull it down to the next level, and you bounced right between the 50. There's one case where you went between, there's the 50 and there's the 61.8. But again, that bounce was contained and never exceeded the 61.8. Fell just above, right in between the two. And then finally, again, this is closest to the drop that we've had now, and you can see right almost to the button, a hair above the 50% Fibonacci retracement line. And then boom, another leg down. All right, so that's it. Doesn't guarantee anything. You can also see, look at this. See the blue line right here? That is the 200-day simple moving average. It comes in right here. The 200-day exponential is just below it, and that's what capped this bounce once we broke it. We were below it, clearly below it here. That was a back test of the 200s. Now we're going to go back to today. Look at that. We're right there, hair above the, little bit above the 200 simple moving average right now. And again, I already showed you the Fibs, so no reason to do that anymore. Okay, guys, I hope you find it useful. And the takeaway is, there are no guarantees. As much as, maybe if I made a very compelling case, maybe if you believe it, all it is there's still no certainties. It's just probabilities. That's what trading is all about. Probabilities, not certainties, because there are no certainties. Put the odds in your favor. Take the shots when things line up, and then the key is, cut your losses if wrong. Know where you're going to get out of that trade if your analysis proves incorrect, and never risk $1 to make $1. If you're swinging, if you're long-term trader and you're going for my next target down here, or your own that's somewhere around there or lower, 299.15, that second target. And again, I can't tell you because everyone's different. If you shorted up here and took any or all of those shorts there, you could even allow for a pop, a new high, and still have a profitable trade if, assuming it plays out, and not violate an attractive risk-reward ratio of, say, 3 to 1. Because if you shorted there, you're going for, from a drop from 400 down to 299. I have to do this. That's going to be, let's say you shorted near the top, and you're going down to about 300. You're talking a 25% target. And that's just a T2. If we get to T2, remember, I keep saying this, if we happen to get down to T2, it's going to open the door, increase the odds of T3, T4, not simply because, we're getting closer to there, but then at this point, a lot of my longer term indicators that haven't yet rolled over from bullish to bearish will most likely have rolled over at that point in time. So let's see, first things first. This whole thing may just go like this, and this whole video was for naught, but I think there's some takeaways, because even if this one doesn't play out this time around, at least you have an understanding and you see the value of using Fibonacci retracement levels, especially in conjunction with other TA tools, other technical analysis tools, price resistance, divergences, trend lines, moving averages, and all that other good stuff. All right, we'll wrap it up here, and I'll get the video out to you guys, and I will follow up later today. I've had some feedback on the semiconductors, and I am working on culling down my list to some of the top picks in that sector. And I'll make a point to get either some chart images and or another video out with some individual semiconductors with levels, objective levels to short or to go long if you're a bull, and then price targets as well. All right, this has been Randy Finney with Right Side of the Chart. Have a great day.